video, we will learn what are some of the things that an enterprising investor can consider doing. It requires a great deal of boldness and a great deal of caution to make a great fortune. It's hard work. And when you have gotten that big fortune, it requires 10 times as much wit to keep that fortune. Very important. It's hard not only to make a big fortune, but much more harder to keep that fortune. So on that backdrop, let's revise who's an enterprising investor. We've covered this in the previous video, but an enterprising investor is one who will devote a fair amount of his attention and efforts towards obtaining a better than run-of-the-mill investment results. So this is serious business. Investments for an enterprising investor requires huge amount of time commitment and great deal of attention on a regular basis for them to have a fair chance of making better than average returns. There is no middle ground. You have to have this basic decision clear in your mind by now if you are an enterprising investor or a defensive investor. So far in the last 10 videos, we've gone through in quite a bit of detail. If not, take a look at some of those videos. But if you have not gotten this clarity, then everything gets tough. There is no middle ground or a quasi state in between where you could be a little bit of enterprising but mostly defensive. No, it's either defensive or it's enterprising. If it's enterprising, you better treat it as your business operation where you spend a lot of time and energy doing it. Growth stocks is an area where the enterprising investors can also look at on top of the value stocks. Defensive investors better off just focusing on the value stock. So what is a growth stock? Growth stock is a stock of the company which the company generates substantial positive cash flow and whose revenues and earnings are expected to increase at a much faster rate than the average company in the same industry. Well, you have to remember that a faster rate cannot sustain for infinite time. So you want to be sure that you're really good at value analysis, using techniques to ensure that you don't pay a full price for that future growth already today, that you're getting it at a discount. So there are 4 ideas in this book to consider for an enterprising investor. Buy in low markets and sell in high. So you get really good at market timing. It's hard, but that feeling of when the market's high or low comes with huge amount of experience. But so that's one. Second, buy carefully chosen growth stocks, buy bargain issues, and it could be any stocks, or buy into some specialist situations. Let's look into it. Buy in low markets, sell in high. So this feel of trading comes after a long period of investing and trading. Only then would you know if it's high or low, and if it's still very subjective. There's no reliable mathematical basis for predicting low and high times. Schiller index and whole host of things, according to Benjamin Graham, who has a huge background in mathematics. Even after looking at 50, 100 years of data, he says there is no reliable mathematical basis for predicting low and high times. So if you do end up predicting low and high times in the wrong way, then you probably miss out if the market just keeps going up, like what's happening for the last 10 plus years in the US right now in 2019. And you may sell at the wrong time. You may be selling when it's still going to go up, or you may buy at the peak. So market timing is a very difficult game, but that's what you would have to get good at. So instead, what's best is to just focus on asset allocation that we've discussed in the previous videos. Alan Greenspan, also who was the chairman of the Federal Reserve, had a really hard time saying when it's high or low. So anyone else who's proclaiming that they could tell when it's high or low in the market, bull or bear phase, it's deluding themselves. It's purely just for entertainment. Whoever is able to predict with high degree of precision that it's a high time or a low time. Two, buy carefully chosen growth stocks. So these are stocks that have outperformed their revenue estimates compared to the average company in that industries, but ensure that you don't pay a full price. So you need to know value-based analysis. Have some sort of guardrail, so less than 20 PE or 25 PE for the last 7 years average. Remember that if you go with growth stocks, most likely the prices are already going to be very high. Ensure that not all of the future earnings are factored into the current price, otherwise you are just paying the full price. There's going to be a lot of momentum volatility because everyone's wanting to buy that growth stock. So you need a lot of guts and courage to buy, but at the same time, you need the patience for that right time to come for that stock price to appreciate. Remember, if you are getting into the game where there are pros focus 100% of their time just doing investing, and they have huge army of staff doing growth based stock picking, so there's a huge amount of caution needed. That's why there is no ambiguity. If you're an enterprising investor, you have to go full in and you spend considerable amount of time doing this if you have to really have any chance of beating either the index or beating some of the mutual fund counterparts. Three, buy bargain issues at various types. So it could be, doesn't have to be just large company. It could be a deep value discount at a small company. It could be a secondary company who's not a market leader. So there are three different bargain issues that you can buy. Ensure again you are really good at value analysis, and there are some things that you can maybe look into, like if there's a temporary setback because of some bad news or some lawsuit that you know for sure based on your competence that it's going to overcome that, and that there is financial stability and huge moat to go through this difficult time and come out stronger because of effective management and manpower that the company has, and that it's a low PE, but at the same time, the earnings did not fluctuate so much in the past that there is some fundamental issue that the earnings have gone down, so the price has gone up. And so be sure to have some quality guardrails. We're looking at various P's, less than 2025 is probably ideal, and stability in earnings in the long period in the past. Only then get into something like an unpopular large company. Sometimes it comes at a discount, or a small company at a very big discount as well. Or a market lagger, not a lagger, but a secondary leader who's not had the limelight yet. So these are opportunities to buy into. Special categories where you know there's going to be a demerger, then value unlocking happens. Insider info, in a lot of countries it's illegal, so be very, very careful. But some countries, that's how they operate. Lawsuits and bad information and news cause stock prices to be highly, highly under pressure. These are special categories of situations where you could, if you are an enterprising investor, buy. So in summary, there's no middle ground. That's the key learning of this entire video. If there's one thing you can remember, it's there's no middle ground. Either you're a defensive investor or enterprising. Be very sure and be 100% of that. Even professionals cannot time the market. We looked at Alan Greenspan's example. Diversify. People in the Fortune 400 year over year, you see that those people don't stay there. They don't need to make a lot of money on that huge fortune. They just need to make market returns to continue being at that level. But a lot of them don't diversify. So to keep your wealth, diversify. Even use foreign stocks if possible. Value analysis is the key needed to master this game of being an enterprising investor. Spend considerable amount of time and energy to take courses, get deeper understanding of value-based investing. Money can only be made during bargain times. Remember, only if you buy a stock at a discount that you have a chance of making money on it. So having that courage and that guts to buy during the discounted, depressed time period, or during a recession, or during a bear market, and selling during extreme euphoria is the key psychological development that an enterprising investor needs to focus on to get really good at having any chance of making money. Hope you found that useful.